Do you even know what a bond is? This is a way too fast rundown on what a bond is. So when a big company wants to raise money, I guess it wouldn't be big until it raised money, but if a company wanted to raise money, there are three ways to do it. Common stock, which is like voting, that's the stuff you see in CNBC. Preferred stock, which is like a fixed income, but it's still equity. And then we have bonds, where they're actually borrowing money from the investors. That's like when you watch Shark Tank and see Mr. Wonderful go, I'm not going to do equity, I'm going to lend you money as a line of credit. That's kind of the same thing. So in a nutshell, a bond is when an investor like you lends money to my company. So if I'm going to borrow money from you, you're going to lend me like say $1,000, and let's say it's a 10% rate at the time, which is expensive. I would pay you back $100 a year, which is 10% of the 1,000 for 30 years, and then I give you your 1,000 back. Not bad. I give me 1,000, I give it to you back in 30 years, but I pay you along the way. So that's a normal type of bond where you lend me money as a company. I will have to pay you back. I know that I owe you the money in 30 years, but I'm going to pay you an interest rate, like a going interest rate over the years, every 6 months for the money you lent me. I'm paying for that. And what I'm going to do is I'm going to take that money you lend me and invest it in other projects or expansions or something like that. And my goal is that my return on investment will be more than I have to pay you, or it becomes not such a good deal. So that's one way. That's a term bond. That's one way to do it. Another one is what they call a zero coupon. A zero coupon bond is where you lend me money, like you lend me like $400, and I don't pay you anything during the life of it, which kind of sucks. But at the end of the 30 years, I give you back like 1,000. So your interest is coming all at the end. There are tax issues with that, but who cares? The point is, you're going to lend me $400, and I'm going to give it back to you in like 30 years, but I'm going to give you 1,000 back. So that extra $600 that you got is considered interest. So by issuing a bond, you're not giving up ownership of your company. And that's why Mr. Wonderful sometimes has a great pitch where he goes, look, I don't want as much equity. You want to give up 25% of your equity to these other idiots. I'll give you a line of credit. I'll lend you the money at a rate. And then when it's done, I'll only take like 2 or 3% of the company. That works for everyone because he gets his money back. You didn't give up voting stock. You still have equity, but you got your money to raise capital with. Okay, so again, I'm going really way too fast into this. I have a lot of videos, bad English, a lot more videos out there explaining it in much bigger detail. I'm just trying to give you a short little 4 or 5 minute video to give you the overview. So corporate bonds are issued by corporations, Tesla, Twitter, Apple, stuff like that. Now, they have a credit rating based on Moody's or S&P, and that's going to determine the risk, the reward you get. So the more risk, the worse credit rating that company has, like say double B or a B, the lower it is, the more they have to pay you because it's risk reward. The more risk they have, the higher the coupon is, the more you're going to get paid for buying this bond. But you are taking on risk. Now, we can mitigate that a little bit by adding features. Like I can secure it and say with assets that I have as a company and say, listen, don't worry about this. If I default on the bond, I have these planes or this property or this portfolio of stocks that I will sell, or the trustee will sell to pay you off if I don't pay you, which makes you feel better. That's one way to do it. Now, another way to issue a bond is issue a debenture, which is an unsecured bond, which is, I just promised to pay you. But if I default, get in line with all the other creditors. Now, that's riskier too, so guess what? You get a better return. Now, that's corporate bonds. Another type of bond is a muni bond or a municipal bond. That's issued by cities, states, towns, stuff like that. And the advantage to that is that the interest that you get is not taxable. So since it's not taxable, it's a lower coupon, which isn't good. But if you're rich, if you're making a lot of money, you want this kind of bond because you want income that's not taxable. So that's why I say rich people buy munis, poor people buy corporates, okay? Corporate bonds are fully taxable, so poor people in the bottom half of the income stratus, they would buy corporates because they don't worry about taxes on the federal level. And then rich people would buy munis because it's cheaper. Now, there's a third type of issuer called the U.S. government. Those are treasury bonds. Treasury bonds are issued by the government. Now, they don't really have any credit risk because literally the government can cha-ching print their own money. So that treasury bonds, and there's different types. There's T-bills, which are short-term. T-notes are 2 to 10 years. T-bonds, they have tips that match inflation. They also have strips that are, that's not where you're going tonight. A strip is like a long-term zero coupon. Like, remember I said before, you lend me 400, I give you 1,000. Well, the federal government does this too, where you lend the government $200, and in like 30 years they give you 1,000. So those are the 3 types of issuers: corporate bonds, municipals like cities and states, they're tax-free, and then the treasuries, you buy them because they're very safe. So as a quick little wrap-up, companies can issue either equity ownership and they give up ownership, or they can issue bonds and they just borrow the money and they pay it back. And once it's paid back, they're done.